Hello and welcome back to The Note. We've had a big bounce back today and it's quite clear why that's happened. It's due to this data here. Given it's the first day of the month, we have PMI data, surveys of supply managers in the manufacturing sector from around the world. Broadly comparable because they're all fixed so that any number above 50 shows expansion, any number below 50 shows contraction. And at first you wouldn't think this was a reason for any great optimism. That big thick red line there, the composite number for the worldwide number, is falling and it has actually hit exactly 50. That many countries are seeing a decline in that number, but critically the US, after some very disappointing data in the last couple of months which helped drive the recession scare, is now back up to 49.5. Still a negative number, but obviously the direction is very good indeed for sentiment. As a result, we had the best day for the S&P 500 in a while, and we had a recovery in many other stock markets as well. If you look at the oil price and at the S&P 500, they're both back to levels they last saw at the beginning of January. Now, what's interesting is if we now take a look at the effect on bond markets and on currencies, we've seen a very sharp rise in Treasury bond yields today. That widens the differential with German bunds, and it has therefore strengthened the dollar against the euro. The dollar has strengthened in general against other developed market currencies. Now, that is potentially a cause of concern. It was the run on emerging market currencies, it's the run on metals prices, which are very important to emerging economies, that helped dissuade the Fed from raising rates back in September, that raised the fear of some form of an emerging market crisis. So far, the strengthening of the dollar against other currencies hasn't changed the general slow recovery for emerging market currencies. They are still rising gently. Metals prices are still slightly higher than they were at the beginning of the year. There is some sense at least that both of those aggregates have bottomed, or at least that they're stabilizing, and that is enough to again help assuage the nerves somewhat. The big issue is whether the signs that the US economy is stronger than thought could affect the rates picture. Here is the latest shift in rate expectations illustrated for you. This is the implicit probability derived by Bloomberg from the Fed Funds futures market of at least one rate rise by the September meeting of the Federal Reserve. And you can see that as we started the year, this was seen as an almost 90% probability. 3 weeks ago, less than 3 weeks ago, it was seen as a less than 2% chance that we would have a rate rise by then. It's now back to a 50-50 shot. Given that this will be just after the presidential campaign has begun in earnest, many people would think that if the Fed are prepared to raise rates, they would like to do it earlier than that. We are back into a regime of substantial interest rate uncertainty. If concern about rates ends up creating the same kind of issues we've already experienced, putting pressure on emerging markets, pushing up the dollar, then we could be in for yet another downward cycle. One final point. Plainly, the direction is up for now. Take a look at these numbers provided by Societe Generale. This shows you earnings per share in local currency going back a decade. In the case of both Europe and the UK, earnings are lower now than they were 10 years ago. We are in something of an earnings slump. That does lead to hopes that it can recover, but just bear that in mind when people try to get excited about the stock market.